40,000 restaurants, 100 countries, over 2 billion customers served every single year. And somehow, after 86 years in business, the Golden Arches are still finding new ways to grow. Welcome to episode 101 of Charged Alpha. I'm Hudson Thomas.
And I'm Lana Chen. Today we're breaking down McDonald's Corporation, ticker MCD, one of the most iconic brands on the planet, and a stock that has compounded wealth for decades.
And here's the thing, Lana, this isn't just a burger chain. When you really dig into the numbers, McDonald's is a real estate empire that happens to sell Big Macs. That distinction matters, and we're going to unpack exactly why today.
It absolutely does. And the timing is interesting because McDonald's just came off a really strong Q4 earnings beat while navigating a pretty complicated macro environment. There's a lot to get into.
So let's set the stage. McDonald's was founded back in 1940 by brothers Richard and Maurice McDonald in San Bernardino, California. But the real growth story starts when Ray Kroc came along in 1955, turned it into a franchise machine, and built what we now know as the largest fast food chain on earth.
And that franchise model is really the key to understanding McDonald's as an investment. About 95% of McDonald's restaurants worldwide are franchised. The company collects royalties, typically around 5% of sales, plus rent from the properties it owns or leases. It's a capital-light model that throws off enormous cash flow.
They're headquartered in Chicago, Illinois, roughly 150,000 employees. The stock sits in the consumer cyclical sector under the restaurants industry. And as of today, shares are trading around $310, giving you a market cap of about $221 billion.
To put that scale in perspective, that's larger than the next several restaurant companies combined. The company's competitive moat rests on 4 pillars: that massive real estate portfolio, the franchise model's stable cash flows, one of the most recognized brands in human history, and a rapidly growing digital ecosystem that's creating entirely new revenue streams.
And the why now question is a good one. McDonald's just delivered Q4 2025 results with 5.7% global comparable sales growth and 6.8% U.S. same-store sales growth. They're executing what they call the Digitizing the Arches transformation with Google Cloud, targeting 250 million loyalty members and 50,000 total restaurants by 2027.
The person driving all of this is CEO Chris Kempczinski. He took over as president and CEO back in November 2019 and was named chairman of the board in 2024.
Kempczinski has an interesting background. He grew up in Cincinnati, started working in restaurants at age 16 as a dishwasher, got his undergraduate degree from Duke and an MBA from Harvard Business School. He spent time at Procter & Gamble in brand management, then held senior roles at PepsiCo and Kraft Foods before joining McDonald's global strategy team in late 2015.
On the street, he's viewed as a growth-focused, tech-forward leader. He's the architect behind the Accelerating the Arches strategy and now the Digitizing the Arches transformation. He's been aggressive on digital ordering, loyalty programs, delivery partnerships, and AI-powered operations. His relationship with franchisees has been somewhat contentious over new evaluation standards, but the results have been hard to argue with.
All right, Lana, let's get into the numbers. This is your arena. Where do we start?
Let's start with valuation. McDonald's trades at a trailing PE of about 25.8, which is actually pretty reasonable for a company of this quality. The forward PE drops to around 22.5, as analysts expect continued earnings growth. The price-to-sales ratio sits at 8.2, and the enterprise value to EBITDA is roughly 18.8 times.
How does that compare historically? Is the stock cheap, expensive, or somewhere in the middle?
It's actually trading below its 5-year average multiples, partly because of macro concerns and partly because of some softness in international markets, particularly China. The dividend yield is 2.35% with a $7.26 annual payout, which is solid for a mega-cap name. The beta is just 0.53, making this one of the least volatile large-cap stocks you'll find.
Let's talk revenue. What does the growth trajectory look like?
Trailing 12-month revenue came in at about $26.9 billion. Looking at the quarterly trend, you can see nice progression. Q1 2025 at just under 6 billion, Q2 at 6.8 billion, Q3 at 7.1 billion, and Q4 at 7 billion. Year-over-year revenue growth is running about 3.7%, which might sound modest, but for a company this size generating these margins, that's meaningful.
And speaking of margins, those numbers are pretty eye-popping for a restaurant company.
They really are. Gross margin is 57.4%, and operating margin is 46.1%. Those are more typical of a software company than a restaurant chain, and it all comes back to that franchise model. When your franchisees are running the restaurants and you're collecting royalties and rent, your cost structure looks very different. Trailing EPS is about $12, and the company earned $3.03 per share in Q4 alone.
What about cash flow? That's where the rubber really meets the road for a capital return story like this.
Operating cash flow over the trailing 12 months was $10.6 billion, and free cash flow came in around $7.2 billion. Those are substantial numbers. The company is investing heavily in growth, with CapEx guidance of $3.7 to $3.9 billion for 2026. But even after those investments, there's plenty of cash left over for dividends and buybacks.
Now, one thing that always catches people's attention when they first look at McDonald's balance sheet is the negative equity. Can you explain what's going on there?
Sure. McDonald's has about $774 million in cash and roughly $40 billion in long-term debt, with total debt including leases around $55 billion. The equity is negative $1.8 billion. That sounds alarming, but it's actually by design. McDonald's has spent decades returning capital to shareholders through buybacks, which reduces equity. The company's cash flow generation is so strong and so predictable that it can comfortably service this debt. The interest coverage ratio is nearly 8 times, which is quite healthy.
So the negative equity is a feature, not a bug, of the capital return strategy.
Exactly. Overall, McDonald's financial health is strong. The combination of industry-leading margins, massive operating cash flow, a durable franchise model, and predictable revenue streams gives the company significant financial flexibility even with an aggressive capital structure.
Let's talk about what Wall Street is saying. How are analysts positioned on the stock?
The consensus is a buy, with 37 analysts covering the name. The breakdown is 20 buy ratings, 15 holds, and just 2 sells. The median price target is $354, which implies about 14% upside from current levels. The range runs from $260 on the low end up to $407 at the high end.
Any notable recent calls worth highlighting?
Several analysts moved their targets higher after the Q4 beat. Argus Research raised to $380, Tigris Financial went to $385, BTIG raised to $370, and Citi nudged up to $375. Erste Group upgraded the stock from hold to buy. The common thread across these calls is that the value menu strategy is working, the digital transformation is gaining traction, and the stock's valuation has gotten more attractive after pulling back from its highs.
So the street is constructive but not unanimously bullish. Seems like a reasonably balanced setup.
That's a fair characterization. The bulls point to the franchise model's resilience and digital upside, while the hold camp is watching for international execution, particularly in China, and wants to see how the macro environment unfolds.
All right, let's do the bull and bear case. I'll take the bull side. The bull case for McDonald's starts with the digital transformation thesis. This company is targeting 250 million active loyalty members and $45 billion in annual loyalty system-wide sales by 2027. When you layer personalized offers, AI-powered recommendations, and delivery integration on top of the world's largest restaurant network, you get a flywheel that's really hard to replicate.
The bear case centers on a few structural concerns. First, franchisee relations. The independent franchisee groups are pushing back hard on new evaluation standards, and organized resistance could slow the rollout of key initiatives. When your business model depends on franchisees executing your vision, that tension is not trivial.
Fair point, but the second bull catalyst is the international expansion runway. 50,000 restaurants by 2027, with 2,600 gross openings planned for 2026 alone. over 1,000 of those in China. The addressable market is still massive, and McDonald's brand recognition gives it a built-in advantage entering new markets.
And that brings me to the second bear concern, which is execution risk in those very international markets. China's same-store sales have been soft, and trying to open 1,000 locations in a market that's underperforming is a real risk. You're also exposed to currency fluctuations and tariff uncertainty across 100-plus countries.
The third bull driver is the value positioning. In an uncertain macro environment, McDonald's actually benefits from trade-down behavior. When consumers cut back on dining out at full-service restaurants, a lot of that spending shifts down to quick-service chains, and McDonald's is the dominant player in that space.
But the bear would counter that rising labor costs and commodity inflation are persistent headwinds. Even with McDonald's scale advantages, higher wages and food costs compress franchisee margins, and there's a limit to how much pricing power you can exercise before you lose the value-conscious customer.
Let's put McDonald's side by side with some peers. We're looking at Chipotle, Domino's Pizza, and Darden restaurants.
Starting with Chipotle, ticker CMG. It trades at a PE of about 35 times with a PS ratio around 3.8. Revenue growth is running about 14.6%, which is significantly faster than McDonald's. But CMG doesn't have the franchise model stability, the dividend yield, or the international scale that McDonald's offers. You're paying a big premium for that growth rate.
What about Domino's?
Domino's, ticker DPZ, actually trades at a lower PE than McDonald's around 22 times with a PS of 2.5. It has a heavily franchised model and strong delivery positioning. However, DPZ carries significantly more leverage relative to its size and doesn't have the brand diversification or the real estate portfolio that underpins McDonald's cash flows.
And Darden?
Darden, ticker DRI, is the value play in this group at about a 19.5 PE and a PS of 1.7. Its Olive Garden and Longhorn brands provide defensive full-service positioning. But Darden is primarily a company-operated model, without the franchise economics or global scale that define McDonald's investment thesis. McDonald's commands a premium valuation, but there's a reason for it. The margins, the cash flow, and the global franchise network are genuinely differentiated.
Let's check in on the options market. What are traders telling us with their positioning?
The put-call ratio on MCD is 1.1, which shows a slight bearish lean. More puts are being purchased than calls. Implied volatility on the June 2026 contract sits around 21%, modestly above the 18% 12-month historical volatility. On the call side, open interest clusters around the 320 to 340 range, suggesting traders are positioning for a moderate move higher. Put interest is concentrated around 290 to 300, indicating downside hedging.
So not exactly a conviction trade in either direction.
No, the options market is reflecting cautious sentiment rather than any extreme positioning. There's no big unusual activity suggesting someone knows something the rest of us don't. It's more of a wait-and-see posture, which makes sense given the mixed signals between strong U.S. performance and softer international trends.
What about insiders? Are the folks running the company buying or selling?
This is noteworthy. Over the past 6 months, there have been 14 insider transactions, and all 14 were sales. 0 purchases. Joseph Erlinger, the president of McDonald's USA, sold about 2,600 shares in February worth roughly $854,000. Dario Baroni, another senior executive, sold 600 shares in March.
All selling and no buying. That catches your attention.
It does, but context matters. Insider selling can be completely routine. Diversification, tax planning, estate management. These are well-compensated executives whose net worth is heavily concentrated in McDonald's stock. That said, the complete absence of any insider buying over a 6-month period is a data point, and it's worth keeping on the radar.
Let's run through the key risks and watch points. What should investors be monitoring going forward?
The first watch point is franchisee satisfaction. The new value standard evaluation system is creating real friction, and how McDonald's navigates that relationship over the next few quarters could impact execution on the ground. The second is international comparable sales, particularly in China. If the 1,000-store expansion plan runs into a sustained demand slump, that's a material headwind.
And on the macro side?
Third is the broader consumer spending environment. Tariff uncertainty and inflation could pressure traffic volumes even among value-oriented consumers. And fourth, keep an eye on the digital metrics. McDonald's has set ambitious targets for loyalty engagement and system-wide digital sales. If those metrics plateau or miss targets, it could challenge the growth narrative. The next earnings report should give us a much clearer picture on several of these fronts.
All right, bring it home for us. What's the bottom line on McDonald's?
McDonald's is one of the highest quality business models in the public markets. 57% gross margins, 46% operating margins, over $10 billion in operating cash flow, and a franchise model that has proven resilient across every economic cycle for decades. The stock trades at a reasonable 26 times trailing earnings with a 2.3% dividend yield, and the street sees 14% upside to current targets.
The risks are real but manageable. Franchisee tensions, international execution, and macro uncertainty are all legitimate concerns. But this is a company with massive competitive advantages and a management team that's leaning into digital transformation to drive the next leg of growth.
The key metric to watch going forward is global comparable sales trends alongside loyalty member growth toward that 250 million target. Those two numbers will tell you whether the digitizing the arches strategy is translating into durable, profitable growth or whether the franchise model is hitting its ceiling.
I want to close with a quote that I think captures the McDonald's philosophy pretty well. Colin Powell once said, "If you are going to achieve excellence in big things, you develop the habit in little matters. Excellence is not an exception. It is a prevailing attitude."
I like that. And it really does apply to McDonald's. Every Big Mac assembled the same way, every drive-thru optimized for speed, every piece of real estate chosen with surgical precision. It's the relentless focus on execution in the small things that built a $200 billion company.
Well said. And that's going to do it for episode 101 of Charged Alpha, our deep dive into McDonald's Corporation, ticker MCD. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, no sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.